Hi, everybody. This is Peter Schiff. This is Tuesday, December 15th, 2009. And one interesting thing that I happen to notice is a lot of the dollar bears, or people like myself who have been bearish on the dollar, one noted individual, Jimmy Rogers, have recently become bullish on the dollar, at least short-term bullish. They still maintain that in the long run, the dollar is going to go way down, but in the short run, they expect it to rally. And the reason everybody is looking for a dollar rally is because they claim that everybody else thinks the dollar is going to fall. And so they're making what amounts to a contrarian call on a short-term dollar rally. Well, one problem with that argument is that a lot of people are now claiming to be contrarian by making that call, which kind of diminishes the contrarian nature of a call that many people are making based solely on the fact that other people are going in the opposite direction. Now, I certainly have some sympathy for that perspective. It is possible that the dollar can rally. It could rally the way it did in 2004 when, late 2003, early 2004, everybody was bearish on the dollar, or a lot of people were bearish. The dollar ended up rallying in 2004. Ultimately, it fell dramatically in 05, 06, 07, 08, but it did have a sucker rally in 2004. But it wasn't that dramatic. It was nowhere near as dramatic as the rally the dollar had late 2008. But from my perspective, even if the dollar does rally, I don't think the rally will be significant enough to warrant selling euros or Swiss francs or gold or other currencies to buy the dollar to try to trade this rally. Because I think the risk is that you're in the dollar and it collapses, not that you're out of the dollar and it rallies. Because I think there's a lot more downside risk if the dollar collapses than upside potential if it rallies. And another way that a lot of the dollar bears can be proven wrong on their bearishness is if the dollar moves down a lot more than they think. Remember, most people on Wall Street who are negative on the dollar expect it to decline in an orderly manner. They don't expect it to collapse. So if the dollar were to drop precipitously, that would surprise just about everybody. So that's another way that the consensus can be wrong. Also, if you look at some of the economic news that we get today, again, that's being people think it's bullish for the dollar, but it's not, is the inflation numbers. We got the PPI number that came out today for November that showed a 1.8% monthly increase in producer prices. Now, that's enormous. I mean, that's more than twice what the forecast was, but that's a big jump in producer prices in just a single month. And, of course, a lot of people think, this is bullish for the dollar because it's going to cause the Fed to tighten. I don't think the Fed's going to tighten at all. I mean, you got an election coming up in 2010, late 2010. The Fed isn't going to tighten, I don't think, into that election, despite the fact that it should be tightening. It should have already tightened. So I think, again, the Fed is more bark than bite, and I think the currency traders are going to figure that out. But also, when you look at the inflation, the government is trying to downplay the significance, and so is Wall Street, of these PPI numbers, because they claim that, well, yes, these are big increases in producer prices, but that it's not going to translate into higher consumer prices because the economy is weak, there's all these unemployed people, businesses can't pass on the higher costs, so they're just going to eat it. And while that might be true in the very short run, in the long run, if these higher costs are persistent, and I think that they will be, businesses will adjust, they will reduce capacity, and they will be able to pass on these higher prices because they'll be servicing a smaller clientele. An example would be an airline. Think about the airlines. If there's a big jump in fuel costs, or their interest costs go up, or their maintenance costs, and they want to raise prices to offset these higher costs, if they can't do it because they have too much capacity, that if they raise prices, the planes are going to be empty, that could actually hurt them. So in the short run, they might operate at a loss. But long run, they're going to change their business. They're going to take planes out of circulation. Either they'll store them in the desert, they'll sell them, they will cancel flights, and they will shrink capacity to give them pricing power. Because then they'll be able to raise prices, and they won't have to worry if some people can't afford to fly because they don't have as many seats to fill. And this is what's going to happen through the entire economy. Its capacity is going to come down. Supply is going to come down. So yes, unemployed Americans will be consuming a lot less, but there'll be far fewer products on the shelves. And so the people who do want to consume and who do want to buy things will have to pay much more for the privilege of doing so. That's how you have high inflation in a weak economy, because supply is shrinking even faster than demand, and you get rising prices. Also, if you look at what's happening with interest rates, yields on 10-year and 30-year government bonds today hit their highest levels since, I think, August 13th. That's a pretty big move up in interest rates. The government tries to tell us that this is happening because the economy is improving. That's not why rates are rising. Rates are rising for two reasons. One, it's supply and demand. We are swelling the supply. The government is issuing all this debt, and so there are more bonds out there. That brings down the price of bonds, which brings up interest rates. And also, bondholders want to be compensated for inflation. So the inflation premiums in the bond market are higher. Remember, there are a lot of people that will acknowledge, they'll say, well, inflation's not a problem today, but in the future it's going to be a problem. Well, the future inflation problem has to be discounted into current bond prices. After all, let's say you're buying a 30-year government bond. You're not getting your money back for 30 years. So the inflation rate 2 years from now, 5 years from now, 10 years from now is very important. And that has to be discounted into what you would pay for that bond today. And the rates have to reflect that. So even for the people who don't think inflation is a problem for several more years, it's a problem right now in the bond market and for interest rates. You know, something also I wanted to point out. I noticed that when President Obama, he gave a speech, I think it was yesterday I saw it, and he was talking about the banks. And the idea is that, hey, we bailed these banks out. They're now solvent because of government money or taxpayer money. And now the banks have an obligation to help the economy by making loans. As if President Obama is now going to force banks to make loans that they otherwise wouldn't make. And if they don't do it, I guess there's going to be some kind of punishment in regulation or taxes. So the message to the bankers is, look, make these loans or else. Now, banks are not here to help the economy. That's not their role. They're not charities. Banks are there to make a profit. They're there to make a profit for themselves, their shareholders, and obviously the way they make profits is by making loans. So if a bank is not making a loan, it's not doing it because it's afraid that it's not going to generate a profit. Maybe it's going to result in a loss. So if banks are not making loans, there is an economic reason why they're not doing it. And also, many of the banks may lack the capital for these loans. They may be worried about future defaults and future losses, and so they want to have a cushion. That's a decision that a banker needs to make. We don't want politicians influencing these decisions, forcing banks to make loans that they know are not in the best interest of the bank. That's how we got into this trouble in the first place. If President Obama simply forces banks to make loans that the banks wouldn't willingly make on their own, this simply means that we're going to have to bail these entities out again. They're going to be in even more trouble, and they're going to need even bigger bailouts. We have to understand that we have to allow market forces to allocate credit. And if President Obama really wants to do something to help small businesses get loans, which is what he's talking about, then he ought to balance the federal budget. Because the main reason that there's no money available for small businesses is because all the money is being borrowed by the government. And also the government is guaranteeing mortgages, guaranteeing auto loans. If they stop doing that, then more credit would be available for the very businesses that Barack Obama is so upset are not getting their money. So what we need is less of this rhetoric out of Washington and more real action to rein in all this excess spending and to stop trying to dictate to banks what loans they should or should not make. The reality is many of these banks that were bailed out shouldn't have been bailed out. We should have let them fail. All right. But now that we've made that mistake, two wrongs don't make a right. Except in Washington, there's never a right and there's always a wrong. And they think no matter how many wrongs they do, eventually they make the situation right. But they never do. All they do is create a bigger problem for the economy and then a bigger excuse for themselves to grow government in an attempt to solve a problem that they blame on the market, but in reality was one of their own making. Anyway, that's it for today. Take care. So long.